We're here today with Stefano Doherty of First
Home
Mortgage. I wanted to ask him some questions about assumable mortgages because I've been hearing so much about them lately. People are interested in knowing more about them and how they work and if they can get one on a new purchase. That's what we're here for.
Morning, my name is Stefano. Just like she said, I do work for First Home Mortgage. I'm a loan officer, so you should trust what I say. I definitely know what I'm talking about. Assumable loans, pretty straightforward. It's a very misunderstood topic, but I'll break it down and make it real easy. So there's two types of loans that you can get an assumable loan for, an FHA loan or a VA loan. There's no FHA assumable versus FHA non-assumable or VA assumable versus VA non-assumable. If you have an FHA or a VA loan, it is by default assumable, which basically means that whenever you decide to sell your house, not only can you sell, obviously, your house, but with it, you can have your mortgage be assumed by the next homeowner. Which basically means that your loan, the terms of it, of the note, everything about it is just transferred to the next person, which can be really, really appealing, which is why you're hearing about it now, right? A lot of people that got an assumable loan 3-4 years ago, right, got a sub 3%, maybe sub 4% rate, somewhere in that ballpark, which compared to now, 7%, 7.25%, 7.5%, last year going in the 8%, that can be very attractive, right? Because then you can potentially save thousands and thousands of dollars of interest. So that sounds great. That's awesome. The downsides, though, they take a really, really long time to close. People don't really like talking.
Which is really interesting because I didn't know that at all.
Yeah, they can take months. They can be a nightmare. So you really need an environment where the seller is not super motivated,
right,
where they can afford to take a few months.
Yeah.
To let the process happen. I'm not too familiar with the process because we don't do assumable loans. That's more of kind of like a banking institution would do that process. I'm not sure why they take so long. Doesn't really matter, but they do.
And that actually brings up another point because I had heard that you don't really have to qualify for an assumable loan in the same way.
You just have to qualify for the loan that exists.
Yeah, so you do have to qualify for a loan though.
You have to qualify for that exact loan because that's what you're getting. You're getting those exact parameters.
So they're not going to just transfer the loan to you, and since the other people qualified, you get it. It's going to still be the same qualification.
They have to make sure that you are in fact going to pay back that mortgage. They definitely want their money. So they'll do obviously like a qualification credit check like you would at any other time that you're getting a mortgage, but instead you're just being compared to the parameters of that exact loan because that's what you're going to get. So they can take a little bit to close. What's really nice if you're a seller is if you have a house that's maybe a little bit tougher to sell, maybe needs a little bit of work, you can make it a lot more attractive by having that assumable loan, saying, hey, you know what, house needs maybe $15,000, $20,000 of work. However, you can get this assumable loan and save thousands of dollars of interest every month, and put that money that you otherwise would be spending every month on the mortgage into the house. Could be a pretty powerful move as a seller. And as a buyer, I mean, if you can get a 2-3% mortgage rate, I mean, that's just
You'd probably make up the money in a year.
That's ideal,
on an expensive house, comparatively.
Right. It's much cheaper. Going back to the con of it taking a long time to close, a lot of sellers don't want to wait that 3 months to go from application to close.
Yeah, and the market is still like in the seller's favor, so it's a little tough. You really do have to find somebody, like he said, that is willing to wait because maybe they do have an issue selling it for the right price, the price they want.
Right.
And then down payment. So what happens with the amount of money due at closing for the buyer?
Your buyer has to make up the delta between the market value and the amount of equity that the current owner has. So in layman's terms, say it's a $500,000 house. Buyer has $300,000. The current owner has $300,000 in equity. You as the buyer has to come up with $200,000. That is your down payment.
Yeah, so it's just the difference between what the seller owes and the loan.
Yes. Yeah. Which, it can be a significant amount of money.
Right.
Especially if they've been living there for a long time. But yeah, it's very simple. It's just what they owe and what the loan was for, and it's just the difference. So it's pretty straightforward. But yes, it can be a lot of money, especially around here where, if you got a VA assumable loan 10 years ago, you sat on it for a little while, and then, you decide to move, that's 10 years worth of equity that the new buyer has to make up. So there can be a pretty heavy cash.
Yeah, if it's gone up, 20%, plus they've made all those payments, so it could be quite.
It can be a heavy cash obligation.
Yeah.
But again, at the end of the day, this is all chasing a mortgage rate that you probably won't naturally see. I couldn't even tell you if it's possible. It was kind of the perfect storm of, the government buying mortgage-backed securities. It made mortgages so cheap. I don't know if we're gonna get back to that 2-3% range anytime in the foreseeable future.
Yeah.
So for a lot of people, you know, it's worth it for them.
Yeah.
They can come up with the $200,000, $300,000 in cash. They can wait 3 months. A lot of people, they're hyper-focused on that number. I don't blame them.
Yeah.
So.
Well, so to come up with that money, I think this would be a good option for somebody that either just has a lot of cash or is selling a house. So they are going to cash out on the equity from their first home.
Yes.
And put that towards the new.
Yeah, just transfer it into the new house.
Yeah.
That's what a lot of people do. Every single assumable loan I have seen has essentially been that situation where they're selling and they transfer the equity into the new place.
Yeah.
Yes.
So also you said FHA and VAR.
Yes.
Are some conventional loans also? No, never?
FHA and VA. Nope, ever.
Oh, wow. Okay.
Yeah, just FHA and VA.
That's really good to know too, because I was also under the impression, somebody told me that you have to, you know, go through your original loan documents and stuff, but it sounds like it's pretty cut and dry.
It's pretty straightforward.
Yeah.
It's like qualifying for any other loan. You're just qualifying for a loan that already exists.
So anybody who is selling their place and they have a VA or FHA loan, it's assumable.
Yes.
And if you have a conventional loan,
it's not. Right. I mean, the big ones that you hear about are VA loans, VA assumable loans. It's probably just because there's a lot of veterans in the area. The terms tend to be a little bit better, rates tend to be a little bit better. There's no mortgage insurance at all on a VA loan.
Yeah.
So they are more attractive, but yeah, I mean, if you are really just chasing a low rate, if you can find an assumable FHA, it may not be as pretty as an assumable VA, but at the end of the day, if you're chasing a low rate, it's gonna be your best bet. I mean, you're probably not gonna get anything lower than something in the mid to maybe low sixes nowadays, and that's including paying point.
Yeah,
so.
right, yeah. And the mortgage insurance on a starter home in the area, even though it's this area and it's a little more expensive, the mortgage insurance probably is gonna run from
$180, $200 a month.
Yeah, so
could be more.
So it's not that much of a difference if you take the VA versus the FHA.
No, I mean, especially if you consider how much money you're saving through interest.
Right.
Through interest reduction. I mean, if you have a 3% note rate compared to a 7%, I mean, I can't necessarily quantify that, but depending on your home price, it's going to be 4 figures a month of interest saved.
Yeah.
So, I mean.
Yeah, so you're talking minimum, like, you know, well, not minimum, but saving $800 instead of $1,000.
Yeah, essentially. You're still saving $800.
Either one's really good.
Yeah, you're still saving $800. And quite frankly, right now, we don't know what's going to happen to interest rates. We kept saying that they were going to come down, and they're not. And are they going to come down anytime soon? Well, we don't really know.
No,
doesn't look good.
The last we heard was the end of the year, but they said that it would start in April, and that didn't happen.
That didn't happen.
Now we're
and now it's
April.
June.
Yeah.
It's not going to happen.
Yeah.
In July.
Yeah.
Nothing's going to change. Yeah, we're probably going to have higher rates for longer. So those that do have a VA loan or an FHA loan with a low rate, you're in a very powerful position when it comes to selling that house. You can use that as a bargaining chip for sure.
Right, especially if things do turn in some way. Market favoring sellers, so they're not really having a problem unless there's some issues with the home. But yeah, it is a nice thing to have in your pocket.
It never hurts, you know?
Yeah.
It never hurts.
Yep.
But yeah, pretty much assumables are very straightforward. You're taking somebody else's loan and you're qualifying for it. If you qualify, it just gets transferred over to you. The cons, the exact same loan gets transferred over to you as far as equity position goes, so you may have to have a large cash obligation. They can take a long time to close, and a lot of sellers may not even want to offer them because they might not really care about you, and they may just want to get their money and get out of there as soon as possible. Yeah. But assuming that you are in a situation where it's possible, it is never a bad idea to.
Right, exactly, like ask, you know, is this one assumable?
Yeah,
you know?
Why not?
Yeah. It'd be hard to search for one, I think, but yeah.
Just a quick interjection. I did figure out how to do it, so linked below in the description will be a way to access my search results. I'm not quite sure how I'm going to break it up, but as you can see, there are not that many, so I may just do one search to cover the DMV area and let everybody have access to what I do here. Like I said, just click the link in the description below, fill out the form, and I'll send you all the assumable loans in the DMV once a week.
Yeah,
and a lot of listings, if there is an assumable loan on the property, they'll advertise it.
Sure.
It's actually one of the first things that they say. They'll have in big cap, bold letters like VA 3.5% assumable.
Yeah.
Because that like flies to like a dead body.
Yeah.
Like yes, like please 3.5%. I would kill for 3.5%.
Yeah, exactly. That's like 5% less than it has been.
Yeah, just about something like that. Nice little 4%.
Yeah.
What's 4%?
Yeah. Okay.
Thanks.
Thank you.
Good talk.
Yeah, definitely.
It's gonna be a good week. Let's get to it.
Bye-bye.